Morning, everybody, and welcome to class 4 of our new Agent Kickstart series. Checking the lineup here, see who's all in. A few familiar names, a few new ones. Welcome, you guys, if you are new. Today, we're going to be talking about financing options. So really covering over those main 4, which are conventional, FHA, VA, and USDA. We're not going to dive too much into the not so common ones, such as private financing, owner financing, hard money lending, or even some of those local options that you may have just based off of your markets and where you're at. So if you're interested in those really local types of lending options, be sure to check with your county, check with your city, check with your state, see what options are available. Some of the big ones are like first-time home buyer incentives or loans or grants that they could apply for. So if you want to know about those, make sure to look very local on those. We're only going to be really talking about these top 4 options that you're most likely going to be seeing on the majority of your deals. So real quick, my not so mandatory disclaimer, just to make sure that there's some CYA going on here. I am not a licensed mortgage lender. The information that's provided during this class is for educational and informational purposes only, should not be used as a guarantee for approved financing or loan terms. Financing is determined on a case-by-case basis and should be directed to your local trusted mortgage professional, which is not me. I am a real estate broker. I sell houses. I coach real estate agents on building up their businesses and selling more houses. I do not finance deals. So if you're interested in more details specific to financing options that might work out for your buyers, make sure you have a really good relationship with your mortgage brokers, with your lenders, so that way you can ask them all of the questions and not feel obligated to do anything specific. All right. Quick background about me, and then hopefully we'll get some input from you guys on the next slide. Like I mentioned, I'm a real estate broker here in San Antonio, Texas. I've been doing this now for 10 years and joined up right as soon as I got out of the military. So I filed my paperwork to separate from the Air Force. I started taking my real estate classes, and about 2 weeks after my quote unquote unemployment from the military, I was sitting down taking my real estate exam and getting started in Omaha, Nebraska. So been doing this for a little bit. I've got a huge value on the education and mentorship side of business and of life in general. I feel like there's been a lot of education and mentorship that has gone by the wayside over the past several years as people have become more independent, and people have become more focused on their growth and their success as opposed to reaching out and helping other people. So I take a huge value in that, and I try to put this together to help you guys, especially if you are a new agent in the class, get together and understand those foundational key aspects of what it is to be a real estate agent, how to build and grow your real estate business and get started so that way you can be successful, no matter what the challenges are that you're going to face as we move forward and everything that's going on in our industry. And then last but not least, I am the host of the new Agent Kickstart series. Kay Collier, also in San Antonio, welcome. All right, so announcement minute. Basically what the announcement minute is it's an opportunity for you guys to chime in, get some direct response, maybe a little coaching or brainstorming session about something specific that you guys are facing. This could be an attaboy moment where we congratulate you on something you've accomplished, or it could be hey, I'm really struggling with this aspect of my business. What should I be doing, or where should I be looking? If anybody has anything, feel free to unmute, chime in. Like an auction, 3, 2, 1, going on. All right, that means nobody can unmute for the rest of this class, okay? You'll have to just be quiet. I'm kidding. I'm kidding. You can unmute anytime you want. All right, here's this syllabus, if you will, the table of contents that we're going to be covering. Don't spend a lot of time on this page. You'll see all these titles here in a moment. But at any point, if y'all have questions, please, I encourage you, unmute, raise your hand, tell me to shut up. Doesn't matter. You're not going to offend me. I want to know what questions you guys have, because the whole purpose of being here is to just get a little bit better than you were yesterday. Okay, so if there's something that you're not completely sure about, let's go through that so you can have that full information. All right, so what is financing? Financing is basically the opportunity, okay? It's a way for consumers to actually purchase real estate, okay? Imagine if you were forced to buy your house with cash. Okay, you needed to have money in the bank, cash under the mattress, or something that was said, this is your money. You've saved up $350,000 to buy this property. How many people on this call right now would walk up the street, go to the open house, and be able to buy that house with cash? Not very many, right? I mean, I know most of my money gets tied up in investments or in something else, and I could pull some things out, but to walk around with $350,000 ready to buy a house when I find it, no. And that's minimum, right? 350 right now across the country is like minimum house prices. There's a few markets that are lower, but for the most part, we're talking 350 up. So what financing does is financing actually gives the opportunity to say, hey, look, I'm going to put a little bit of skin in the game, but I want somebody else to actually finance the deal for me, right? That's the investment side of somebody else. And so it allows that opportunity for buyers to say, I need a bigger house. And instead of only affording this small studio apartment with my 3 kids, I'm going to actually buy my 4-bedroom house that I want. Okay. Now you've got different options. You could do fixed rate or you could do an adjustable rate. Right now, adjustables are kind of high and fixed are actually lower, believe it or not, with the rates that they are right now. But at certain times, it may be more advantageous to go an adjustable rate versus a fixed rate. Okay. Because if you've got a client who 100% certainty, they are not going to be living in that house longer than that balloon expectation, an adjustable rate may be a good option for them, because if that rate is significantly lower for the first 3 years and they're only going to be in that house for 3 years, military, for example, right? They may be looking at PCSing within that time frame. I'll sell them an adjustable rate and say, hey, pay the lower interest rate. Just make sure we sell your house before then or refinance it before that balloon payment hits. But I think this is a good option for you. I'm looking at buying a house right now, and I called my lender and I said, hey, what are the adjustable rates doing? I would go adjustable right now if the rates were lower, but they're not. They're up. So just keep that in mind. Those are options to consider. Now, on the adjustable side, if your client is like, well, I think I'm only going to have the house for 2 or 3 years and then I'll probably sell it, and they've got a 5-year balloon on it, you better make sure that they're refinancing before that 5 years. It's not your job. Okay, let me be clear. It's not your job. But as the professional, as the person who's building that relationship with the client, I think it's going to be important for you to be able to look at them and say, hey, we're getting close to that 3.5-year mark. Your balloon comes up at 5. I don't want you to get stuck with a $15,000 balloon payment plus an interest raise of 2%. I want to make sure we can get your deal refinanced if you're planning to stay here a little bit longer, or we need to get this thing on the market so we can avoid that balloon. You need to be putting them in the position of success. Okay, so just be familiar with what that means. Last but not least, any type of loan that you get on a property is going to be a secured debt, meaning that property or another property that the client owns is going to be used up as collateral. Okay, so if you're buying 123 Banana Street and the bank is lending you money to buy 123 Banana Street, that house is collateral. So if they stop making that payment, bye-bye 123 Banana Street. That's going to go up through foreclosure. The bank's going to take ownership of that, and they're going to, try to resell it, rent it, flip it, whatever. Okay. However, if you've got a client who maybe is an investor, they've got multiple properties, they're taking out a bigger loan. Guess what? 123 Banana Street might be in that loan as well, but the bank could also collateral over here 576, Corpus Avenue, right? Depending on how they structure their loan, other properties can be used up as collateral. It's still a secured debt for the bank. Does that make sense? All right. Last bit on here, that asterisk, again, CYA. Okay, if you don't know what CYA is, Google it. But basically, we don't give tax advice. Okay, there are tax incentives for buying real estate. There are deductions that you can take for buying real estate. Now, normally, we leave that to the CPA. Okay, we don't want to sit here and say, hey, Tariq, just want to let you know, when you buy this property, all that interest you pay on your mortgage, that high interest rate you've got right now, hey, man, that's tax deductible. Don't even worry. It's like washing it off. No, don't say that to your client. Okay. Say, hey, look, there's some tax benefits to buying real estate. Okay. It could be lucrative for you. It could be beneficial. It could help offset some of those high costs. Talk to your CPA, talk to your accountant, talk to TurboTax, right? Tell them to talk to somebody besides you. All right. I don't want anybody going into lawsuits and being like, Jonathan told me that I could say this. Not true. Send them to an accountant. All right, let's talk about the beginning process. Okay. Your job as a real estate agent is to be the resource. Okay. Is there anybody on the call right now that is a licensed lender, mortgage broker, any of the above? No, I think this might be the first class in like 3 years where nobody on the call has their mortgage broker license. Anyways, that's good because everything that I say is true for everybody on this call. Normally, I have to tell the mortgage people, hey, look, not everything pertains to you because you are a licensed mortgage broker, but right now put your real estate hat on. So for all of you guys, excellent. Our job is to be the resource. Okay. I am not going to sit here and tell somebody, hey, look, I can get you into this house for a 6.5% interest rate, right? And you can, you only have to put 5% down. Heck no, I have no idea what your financial situation is. I don't care. As long as the lender calls me and says, hey, this person is approved and they can do this amount at this interest rate, I'm golden because that means you can buy a house, right? I don't care how many credit cards you have. I don't care how many car payments you have. Can you afford to buy this house? Yes or no? That's my job. Okay. As the resource, when you're the resource, okay, you're going to put them in touch with that lender. They're going to start doing the process and getting everything together. Okay. That borrower will get a loan application from the lender. When they fill out that loan application as truthfully as possible, the lender's going to get a copy and the lender's going to follow up with them. They'll ask any questions that they may need to ask in order to clarify some information about that loan application. And then they will request specific documentation from the borrower. Okay. On a typical loan, okay, a typical loan, you're going to be looking at things and you can have these suggestions in mind for your clients when you're doing your consultations. So that way they're prepared to talk with the lender and to provide the documents. You're going to want to have their most recent tax return. Okay. You're going to want to have 2 or 3 pay stubs for their past payments, 2 to 3 bank statements, right? So the past 2 to 3 months showing their bank statements. What do we got? Tax returns, W-2s. Well, your W-2s are going to be part of your tax returns, pay stubs, bank statements. If there's any large deposits, okay, they need to be able to justify those large deposits. Okay. Unfortunately, for some reason, banks still don't like working with drug dealers. So they need to be able to allocate for all of the big deposits. If it was a gift from grandma, excellent. Life insurance policy, excellent. Alimony, excellent. Be able to justify where those large payments came from. Okay. Once the buyer submits all of that documentation, the lender is going to compile everything up, the documentation, W-2s, tax returns, all of that, the loan application. They're going to put it into the computer and they're going to email it over to a system. Okay. This AI platform is going to be like, check everything out, see what's going on. Okay, great. Based off of this information that we automatically reviewed, the client is approved or is not approved. Okay. We've got love-hate relationships with the automated underwriting. Okay. Sometimes, awesome. No harm, no foul. But other times, if there's a slight discrepancy or a slight variance, or they are right on the edge of their DTI, debt to income ratio, that they can be to qualify for the loan, the automated underwriting is going to go on the side of caution and say, nope, Jonathan doesn't qualify. His DTI is too high. But you're right at the cusp. And so if the client feels like that's an invalid analysis, the client can actually request to the lender, hey, look, I know your automated underwriting denied the application. I would like for this to go to a manual review. And the lender will send this to an underwriting department to manually review the file, manually determine DTI, manually determine all the facts of the application. And they can actually overturn the automated underwriting system. Okay. So if you feel like the client should be approved or the client feels like they should be approved, send it to the underwriters. Okay. Worst case scenario is it's going to come back denied. Okay. Best case scenario is, automated underwriting had a bad day. Let's approve this thing. Okay. Next up, once the underwriting process is completed, whether it's automated or manual, you're going to get a pre-approval. Okay. Or a pre-qual. Who can tell me the difference between a pre-approval and a pre-qualification? Go for it.
Hi, I'm not entirely sure, but I think that the pre-qualification is before the client shows us the documents,
Okay.
maybe. And the pre-approval is basically with the document. It's proved by his word is proved by the document. I'm not sure if that's
Perfect. Nope, that's absolutely correct. So your pre-qualification is just, hey, I'm qualified, right? Whatever they put on that application determines if they are qualified. Based off the information contained in this application, this client is qualified for X amount of money, okay? I put on the application that I make $15 million a year. Do I make $15 million a year? I wish. I'd be walking around paying cash for houses, right? But if I submit that to a lender, the lender's gonna be like, buy whatever you want, right? But then when I submit my tax returns and my W-2s, they're gonna be like, hold up. You made 15 million, but it's more like 15,000. We're gonna have to take off a couple zeros here. Now I'm no longer approved, right? So if you get something from the lender that says pre-qualified or pre-qualification letter, I want you to be that barrier. Okay, I want you to call that lender and say, hey, Jonathan, I just got your pre-qualification letter for my clients, Jack and Sarah. I just want to verify. Did you guys look over the documents to approve them for financing, or is this just based off of their application? Okay, it's kind of a trust but verify type situation. Every lender should be doing the due diligence to make sure that the client can actually purchase the property. But not every lender is good. Okay. Just like not every real estate agent that you work with is going to be good. All right. So trust but verify. Ask the question and make sure if it's a pre-qualification, if the lender's like, yeah, we looked at all the documents, we give out pre-qualifications, that's just the title of the form. It's the same thing as a pre-approval. It's not. But if that's what they say it is, great. On the pre-qualification letter, does it specifically state that their, documentation was reviewed? If it doesn't state that the documentation was reviewed, I'd approach with caution, maybe get a second opinion from another lender. Okay. Just because I've personally ran into situations with certain lenders that I'm not going to disclose, right? I want to make sure that this call's very quick in that don't really look at all of the details and they just kind of spit things out. Okay. So if you need a second opinion, go get a second opinion. Next up, once they do get that approval or the qualification, they're going to send out those letters. Best practice, do not accept a pre-approval from your client. Okay, your client should not be the one sending the pre-approval. You should get that directly from the lender. If you're not getting it directly from the lender, I would call the lender and say, hey, my client just sent me over their pre-approval letter. I'm excited that they did get pre-approved. As a best practice in my business, I prefer not to get the letters from the clients directly because I don't want to risk there have been any changes made to those documents. Would you mind emailing me your copy so that way I can get it from the horse's mouth? I'm very direct about it because, again, there are some mortgage companies who will send out documents to the buyer, to the consumer, and it's Word documents. Hey, here's what you're approved up to. Feel free to put any amount you want on the pre-approval up to that approved amount. Nobody's monitoring what that consumer does, right? The lender says you're approved up to 500K, but the buyer's like, I want to look at houses that are 600K. So they write in there $600,000. There's no checks and balances once it's in the buyer's hands. Okay. I tell the lender, give me their pre-approval amount. That's what I want to see. If we're writing an offer for under the pre-approval amount, I will reach out to you and get an adjusted pre-approval letter. It doesn't take them very long to print those out once they've generated it. It's just a matter of change the number, but get it from the lender, not from the consumer. Okay. Once you have that pre-approval letter, go start looking at houses. Okay. Is there anybody on here that shows houses before you get a pre-approval letter? And if you haven't started showing houses yet, would you show a house before they get a pre-approval letter?
No.
Okay, says no. Hazim?
I would show them a couple of houses,
Okay,
just to start a relationship maybe with them.
okay,
I mean, if they don't have it yet, that doesn't mean that they won't get it, right?
okay,
So I might probably show them a house or two and then ask them to get that pre-approval.
okay. Not saying you're wrong, just out of curiosity, how many houses would you show before they get that pre-approval?
Maybe 2 or 3 houses.
Okay.
Yeah.
Anyone else have input? I see something in the chat. Ashley says no as well. Okay. So there isn't a right or wrong answer here, you guys. Your business is your business. Okay. I lean on the side of Hazim as well. And maybe he's seen my recorded sessions. I don't know, but he's given all the same answers I give in my videos. But I do about 2 or 3 because we're building relationships with these clients, right? It's really hard for them to trust us to be like, oh, now we're going to talk about finances. I don't know, right? So we're building those relationships. As we move forward, depending on how this settlement comes into play, keep in mind, nothing has changed yet. Okay, so you don't need to go and completely revamp how you do business. But based off of the proposed settlements from NAR, and if you're not following that, go Google it because it's a whole episode. But we're going to need to start having buyer rep agreements signed day one. And I know it's been the best practice for years and everybody should be doing it, but let's be honest, not everybody does it on day one, right? I usually sign those things when we're going into a contract or putting an offer on something because why obligate them, right? If I'm not showing my value during the transaction, screw it, go work with somebody else. I know my value, right? But moving forward with the settlement proposal, we're going to need to sign that before we actually look at any houses. So they're already going to be in a position where it's, you want me to sign a buyer rep agreement stating specifically that you are my agent and I'm not allowed to work with anybody else. And now I'm stuck with you and I don't even know you. And you want me to go talk with the lender? Like, if you got kids around, cover their ears. Holy shit, Batman, that's a lot of pressure on a consumer who met you through Facebook or Instagram, right? And so we're going to, for me personally, again, I'm not telling you how to run your business, just my train of thought. If we're going to have them sign a buyer rep agreement, it could be an exclusive buyer rep for a specific property or a specific list of properties that you're going to go show them for the day. Nothing says you can't do that. Okay. It doesn't have to be a 6-month buyer agency. But if we're going to be having them sign these agreements and say, hey, look, in order to show this property, I need you to sign a buyer agency agreement outlining X, Y, and Z. Now I'm going to make it specific for the properties we're going to look at today. After we're done looking at these properties, I'll discuss with you and see if you'd like to continue, working together moving forward, and we'll sign an exclusive agency. Great. Okay. But now they need to go talk to a lender as well. I'm going to show them 1 or 2 houses and be like, let's look at a few properties, see what you think, get some feedback on it, see if we're a good working relationship together. But in the meantime, I want to make sure you're aware of the process. You're going to need to talk with a lender. You're going to need to contact so-and-so or contact your bank. Put the bug in their ear. Let them know that they do need to talk with a lender. They can get that process started at any point, but they cannot write an offer until they have a pre-approval, is how I lay it out for them. So I'll show you 1 or 2 houses, but I'm not putting anything on paper until you get that pre-approval. Does that make sense, Mr. and Mrs. Buyer? Yes, it does. Great. Let's go look at some homes. Thank you, Kathleen. Now, the other part of that, and the other reason why I kind of lean on Hazim's side as well, is because when a buyer contacts you wanting to look at real estate, what do they want to do? Anybody can chime in. I'll give you 2 options. Do they want to talk with you? Are they reaching out to you because you just look, awesome and they want to talk to you? Or do they want to go look at a house?
Oh,
Love the confidence, right? 99% of the time, I'd say they want to look at a house. Okay. So if I sit them down at a coffee shop and say, here's all our paperwork that we have to do, go get a pre-approval and then go look at a house. Scroll Facebook, next ad. Hey, I want to go look at a house. Boom, they're going to look at the house, right? Like it's that simple to find another agent. There are so many agents I could throw a rock out of the condo I'm staying in right now, and I'd probably hit 3 or 4. And I say that because one of the agents I used to work with actually lives in the development where we're staying right now. So I know I could hit her house from here. But do your business how you want to do your business. I'm not saying you're right or wrong, just thinking about different options as well. Question, go for it.
If I may add, I actually used to do real estate back in Dubai, and a lot of clients would feel a little bit offended when you ask them for the pre-approval right away, as if you're questioning their ability to purchase a house. So that's why I said I would actually show them, like, just try to build a relationship and then go for it.
Yeah.
My question is, you said that we can basically ask the lender to send us a copy of the pre-approval. Isn't that a private information? I mean, are they okay to send it if we're not the ones who actually broke the lender? Like if the client said, I have my mortgage broker and I work with them for a long time, so I'm gonna deal with them directly.
Okay. And it's perfectly fine for the consumer to choose their lender. We cannot force who they use, right? But to answer your question on 2 sides, number 1 is if you have a buyer agency agreement signed, you can give that to the lender and say, I am representing them as their agent. Here's the contract that shows I'm their agent. Boom. That covers the confidentiality side of it because we're already bound by confidentiality, right? Number 2 is if the lender does reboot and say, well, that's confidential to the client. I can't just give that to you. The client should have already said, hey, Mr. Lender, I'm working with Jonathan Silva. He's going to be my agent, and he's telling me I need to get a pre-approval. They should have my name in play, right? They already know me. If they don't, I'm going to contact the client, and I'm very transparent with my clients, right? I don't believe in the shady sales side of things. I'm very transparent with my client, and I'll say, hey, Hazim, just want to let you know I reached out to your lender just to verify the pre-approval that you had sent over. I do need to get a copy from them directly. Would you mind putting us in a group chat or connecting us so that way he knows that I'm working with you to purchase your next property? And I'll put the client in the loop and say, hey, look, we've got to get this figured out. It's not that I don't trust them. It's that I don't trust them, right? So, but no, you're right. There is some confidentiality behind it. Most lenders over 10 years, most lenders, when I reach out to them and I give them the client specific name, if they're married, I give them both, right? Hey, I'm working with Julie and Chris Sims, so I'm buying their property. If I've got that information, chances are I know who they are and I'm working with them. Most lenders share the information because it's not giving away a lot of their personal information, right? It's giving away their name. It's giving away their approval amount and the lender that they're using. It's not giving away socials. It's not giving away phone numbers, maybe their address, which I can pull up on, records of the city anyways. So there's not a lot of confidentiality, but I see what you're saying. So it's just going to depend on the lender. All right, now that we've got through the basic stuff, let's go into specific direct types of financing. Okay, again, as a recap, we're going to be talking about conventional FHA, VA, and USDA as the primary. If you guys have questions, I want you to interrupt. Okay, I want you to, you can unmute, right? If I see you unmute, I will stop talking. You can raise your hand and be polite, or you can go ahead and type in the chat. I want to make sure that all of your questions get answered. So first things first, we're going to start with conventional and FHA. I think these are going to be the primary sources of financing that you are going to be experiencing in your real estate business. Okay. When we look at conventional financing, this is not guaranteed or insured by the government. Okay. These are private investors who put in money and invest in real estate. This could be banks. This could be private investors. This could be, Uncle Sammy down the street who's just got some money lying around and throws it in the pool to do some conventional finance investing. Okay. It is not guaranteed by the government. So because of that, they've got a little bit more stricter requirements on their approvals. Okay. So they're going to have stricter credit requirements. Your credit score has to be a little bit higher. Okay. Than what an FHA loan might be, because they want to make sure that their investment is as secure as possible. Okay. You wouldn't want to just, meet, and hopefully nobody takes offense. I can't remember where he's from, but Hobo Johnson. You wouldn't meet Hobo Johnson down the street and be like, hey man, here's $350, $350,000. Go buy a house and you can pay me back over the next 30 years. No, you're going to want to run your due diligence on him, right? You're going to want to make sure that he's got income coming in, that he pays his bills on time, that he's not a credit risk, right? That's what they're doing. Okay. Now you've got two options. You could do conforming or you can do non-conforming. Okay, now every state's going to have their own, levels of conforming and non-conforming. If you are in a larger state, a higher cost of living state, your jumbo rate, your non-conforming base is going to be significantly higher than if you are in a average, cost of living state. So for example, for Texas, Texas, our conforming rate is right about 766,700. It's got some change to it. Okay. On a high cost of living area, New York, California, I think not Alaska, Hawaii. There's a couple other ones. Those costs of livings are higher, so therefore their conforming rates are higher, right? And so in Texas, if I have a loan that's 800,000, that's going to be considered jumbo, right? And so it's going to have different credit requirements than a conforming loan. But if I'm in California and I've got a loan that's $1 million, well, guess what? That's still considered conforming because I think theirs is like $1,066,000 or something like that. So you've got to check with your local lenders, find out what's conforming and non-conforming. But if I've got a loan that's going to go into jumbo, I'm going to have more down payment expectation. I'm going to have better credit as an expectation, right? Because they want to know, I'm giving them a lot of money, more than a normal person. I want to make sure that they're good. Okay. The other part on conventional financing is your higher down payments. Typically, and I'm going to use the word typically, the down payment requirement for a conventional loan is a minimum of 5%. Okay. If you're in the mindset of, you got to have 20% down to buy a house, get out of that mindset. Okay. That's a consumer mindset. That's a propaganda mindset from the internet. Get out of it. You do not need 20% down. Is it beneficial? 1,000%. We'll talk about that next, but you don't need 20%. You can go as low as 5 in most situations. Okay. First time home buyers. Typically, it's not always, sometimes they change it, but typically first time home buyers can get in at 3. Okay. If you're a first time home buyer, haven't owned a house in the last 3 years, you're applying for conventional financing, see if you have a 3% option for a down payment. It can help you save on that down payment. Now, here's the benefit of 20%. No PMI. Who can give me a quick rundown of what PMI is?
This is Tariq.
What's up, Tariq?
Hi. So it is an insurance for the bank, for the lender,
Yep.
on the loan that you have.
Okay. How does it benefit the buyer?
It doesn't.
Okay. So it only benefits the bank, the investor, right? Now, the plus of it, and Hasim, I'll get to you in a second if you still have that. The plus of it is the buyer doesn't have to come with 20% down, right? The lender's accepting that risk because they have an insurance policy that says, hey, if this buyer forecloses or defaults on the loan, the insurance company is going to step in and pay that difference. Sweet, right? So there's their value to the consumer, but it really doesn't benefit the consumer. The consumer doesn't get anything when they pay off the loan. They don't get any money back or anything like that. It's just part of it. Okay. Hazim, what'd you have? Or did we answer it?
No, we're good. Thank you.
Good. Okay. Now, here's the plus side on conventional that you're not going to find on FHA. Okay. On conventional, you have PMI, private mortgage insurance. Once your home value, your loan to value hits that 80% or lower, you can take off your PMI. Okay. So the PMI is only on the property for that first 20%, right? Between 80 and 100% loan to value. Okay. Once you hit that 80, it's off. So if you're tracking your home's value, or the consumer is tracking their home value, it's not just off of the amortization schedule. Okay. If you go exclusively off of the amortization schedule, when it hits 78%, it's going to get written off. Okay. But if your consumer wants to move it out quicker, because sometimes values appreciate faster than the amortization schedule, they have to be cognizant of it. Who can give me some examples of what changes the home value?
The equity of the house.
Yes. More elaborated on that. You know, what creates equity?
Say when he bought it, it was 100,000, but in
Yep.
a couple of years, you didn't hit 80%, but your value goes to 120. So that's 20,000 is going to be your equity of the house.
Okay. And that was acquired by appreciation?
Appraisal.
Okay.
Yeah. Appreciation of the value of the house.
Of the market. Yep. I figure that's where you were headed with that one. Hazim?
I mean, things around the property, like new attractions, new schools, a
Okay.
new plaza, stuff like
Yep.
that.
Yep. So appreciation again. So really there's kind of 3 areas that are going to affect your home's value. Okay. And this helps you, this helps the consumer as well. The appreciation, things happening around the house, the market conditions, inventory rates, things like that, right? That's going to be appreciation due to market conditions. You've got appreciation through renovations of the home. Maybe they bought the property and they renovated the kitchen, the bathroom, they put a pool in the backyard, which is a plus and a minus, but we're not getting into that. Okay. So renovation appreciation. The third one is paying down your loan, right? If they make extra payments, if they put payments towards principal only, right? Things like that. Paying down their mortgage is going to appreciate their home faster or at Q, right? If they're just paying the base minimum, the home's going to appreciate over the course of the time. They'll hit 78. So based off of those 3 things, right? If they do a home renovation and in a year they find that their market condition has changed and their appreciation has increased by 6, 7, 8, 15%, is it likely that they might have 20% in equity in their home and now they can write off the PMI? Potentially. They have to go get an appraisal to figure out if that value fits. Okay. So if your clients are like, oh my gosh, Hazim, we just did all these renovations. We gutted the whole place and redid it, put a pool and a patio in the backyard and all these things. That's awesome. Congratulations. Let me ask you guys, would you like me to do a market analysis on your home? See where we're at value-wise. There could be an opportunity for you to save on your PMI that you're paying each month, which could be a couple $100s a month. Would you like that? Yes. That puts you in front of your client again. It maintains your professional value to your client. Now you're saving them, a couple $1,000s a year on their mortgage payments. Are they going to refer you to their friends and family? 1,000%, right? So that's conventional financing. Any questions on that? Okay. Rolling over to FHA, again, the second type of loan that you're most likely going to be seeing on your properties. Let me ask you something. Who can get an FHA finance deal? That's why we're in this class. You tell us. Anybody? Nobody? All right, we'll go through it. But the FHA financing is insured by the government, okay? FHA financing was put in place because they were like, you know what? We need more equality in the home buying process. We need more people to be able to get to home ownership, reach that American dream. There's too much, weighted sides of home ownership in the United States. We want to make it equal to everybody to have an opportunity, okay? So there's kind of an answer to your question. Everybody can get FHA financing if they qualify, right? There is no expectation, which we'll get to common misconceptions down at the bottom. But they said, we need to make homes more affordable. We need to make the home process easier for everybody. Let's do a government-backed financing, okay? So they created the FHA. Now, with FHA, lower credit scores and typically a lower down payment options are available for home buyers. So instead of needing a 620, well, now we can drop down to a 580 here with FHA, which makes it a little bit more attainable for a lot of people, right? As inflation continues to go up and wages kind of think about going up a little bit, that credit scores are continuing to be affected, right? Because the cost of living is skyrocketing and our income is not skyrocketing. And so across the board, not us specifically, because we're all rock stars and we're killing it in the markets. But we've got to look at that and say, okay, a lot of people might be coming FHA because the credit scores just aren't lining up, right? So lower credit scores, lower down payment requirements, that is a plus. When we're looking at our down payment requirements on FHA, do you remember what the normal base down payment requirement is on conventional? Who remembers what we talked about?
Benny?
So 3% is a first-time home buyer.
Hmm.
Yeah, but what's the standard?
I think you said 5.
5% is kind of the base for conventional unless you're a first-time home buyer. Good job, Kim, as well. Now, on FHA, we're looking at 3.5. Okay. So 3.5% financing as a base on FHA. Is that going to help a lot of people with their savings for down payments? 1,000%. Hell, some of you on the call are probably like, hey, my tax returns are 3.5% for the house I want to buy. There you go. Now's a great time to call those people and say, hey, did you do your taxes yet? Did you get a return? Let's go buy a house, right? Because now they've got their down payment. Don't go buy the new iPhone at $1,600 a pop. Let's buy a house, okay? Next up on here, your mortgage insurance premium, MIP, same exact thing as PMI. It is an insurance for the investor, for the bank to guarantee that this loan is not going to default and lose the bank money, okay? Now here's the negative. It never comes off. Once you get an FHA loan with MIP, you have MIP. I didn't know that when I bought my first FHA home. It was 2015. 2015, I bought my first house with an FHA. Not my first house, but it was my first FHA house. I bought it FHA. I put 10% down. I had MIP and I was like, oh, I'll pay extra towards it, appreciation, all the stuff and get that off. And my lender's like, they actually changed the rule like a year ago that MIP is on and it's on. And I'm like, oh, wish I would have known that. I would have gone conventional. But it doesn't come off. Okay. The only way to get your MIP off is to do a refinance. Okay. So if somebody's value goes up to the 80-20 rule, they can look at refinancing. Now, it's going to cost a lot more to refinance than it would just to get the appraisal. Okay. So the 80-20, maybe not worth doing a refinance exactly at 80-20. Every client situation is going to be different. So don't take this as gospel. Okay. Every client situation is going to be different, but maybe 70-30. right? Make it make sense to get that. Okay. Next up, yes, there are loan limits, even though this is backed by the government and we know how much the government loves to spend. They don't like to waste money on real estate for consumers. So they do have loan limits as well. It's across the board. They changed this about 2 years ago, I want to say. Don't quote me on it. Where those loan limits are across the board. FHA, VA, conventional, everybody's got the same. It used to be stagnant, right? Like conventional was here and FHA was over here. And then VA is like, no, we don't want to sell too high. So now it's across the board, 766,000 and some change for a general cost of living area. Okay. Higher cost of living areas, go talk to your lenders. I want to say it's like a 1,066,000 as like your base for jumbo. Okay. So take a look at that. Got something here in the chat. Is there an equivalent to FHA in Canada? I will be honest, I have no idea. Y'all are like the Wild West to me. I've got some friends and contacts up there, kind of near Alberta, that I can reach out to and see if they know anything about that, and then try to get you an answer offline. All right, common misconceptions, additional stipulations. A lot of people think that FHA means first-time home buyer. It does not. Okay, you could be an 85-year-old, senior that has bought 60,000 houses in their lifetime, and they're trying to buy their, final home. They can use FHA. You can be a first-time home buyer. You can use FHA. You could be a veteran, and you could use FHA. It doesn't matter. What matters is, do you meet the credit requirements? Can you pay the down payment? And do you qualify on your DTI? Okay. That's the biggest thing on here. That's the one where most people feel trapped that they can't get FHA. It goes along with the misconception that you need 20% down in order to buy a house. You don't. It's just more beneficial, but you don't. Okay. Any questions on FHA? Okay. Oh, I'll add an additional stipulation on here. A lot of people think that once you use an FHA deal, you can no longer use an FHA deal. Not entirely true. The biggest requirement for FHA is it has to be your primary residence. Okay. You have to use it as your primary residence. If you're trying to buy an investment property, you cannot buy it using FHA. It has to be your primary. Now, you could buy it as your primary, live in it for a year, and then, move out of it and rent it out. Sure, you've met the requirement, but you can't buy it with the intention of it being an investment property. Does that make sense? Perfect. VA financing. And I'm going to have to start blowing through some of these because I am way behind. All right, VA financing. This sucks that I got to speed through here because this is like my bread and butter. It's what I do every day and the primary clients that I work with. VA financing is for veterans. Okay. If you've never served in the military, you do not qualify for VA financing. Okay. If you went into basic training, fell asleep, and woke up getting screamed at and you quit because you couldn't hack it, you don't get VA financing. Okay. It's not a debt. They can't touch you, you guys. Don't get scared. They only yell at you. Okay. And they wear really funny looking hats that you can't touch. So VA financing is for the men and women who have served in the military that have earned the right to get VA financing. It's 0% down options. The common misconception and the thing I hate the most when I hear it is, well, your client's not putting anything down. They don't have any skin in the game, blah, blah, blah. Why should we go with VA financing? It's so much more difficult to close than a conventional deal. Bullshit. No, it's not. It's actually easier, but people don't know about it. Okay. So they have a 0% down option because they're doing a lot of other things, right? For the majority, most military are doing a lot of other things. So the government says, you know what, we're going to back them up and we're going to let them buy a house with 0 down financing. And we're going to guarantee that that house is protected. And if the veteran, lost my word, defaults on that loan, we are going to pay off the loan and own that property as the VA. Okay. That's the guarantee. No risk for the seller. Okay. Or for the bank. Now, requirements, like we talked about, you do have to be a veteran. You have to have an honorable discharge or active duty that's qualified for VA financing. If you are other than honorable, you have to specifically have it in writing that you get VA benefits for housing. Okay. If you are dishonorably discharged, meaning you did something that was a no-go, right? you do not have any type of VA entitlements 99% of the time. I'm not going to say every time, but most of the time, dishonorable discharges mean we want nothing to do with you. We release you and you get no benefits. Okay. With VA financing, there is no PMI or MIP even at 0% down. Okay. However, the VA does charge a financing fee, which is basically MIP upfront, right? If you think of it that way. Now, your funding fee is dependent on how much of a down payment they put down. So a VA can put more than 0% down if they want to, it's just not required. Okay, so if they put more down, their funding fee comes down because there's less risk for the VA. Okay, if the veteran is 10% disabled or more, the funding fee is waived. Okay, so for those of you that aren't familiar, if you are active duty, you are not disabled. You will have a funding fee. Okay, so if your client is active duty, there will be a funding fee. If the client is discharged, retired, a veteran, whichever, okay, doesn't mean they have a disability. So we have to ask, do you have any type of military disability compensation? Yes. What's your percent rating? 10, 15, 20, doesn't matter. Is it over 10? Yes. Great. Your funding fee is going to be waived. If they have a funding fee, that can be financed into the loan most of the time, as long as they qualify for that bump up. Okay. On the plus side, even better for your veteran client, if the seller is willing to pay closing costs, that funding fee can be paid by the seller. Okay. So keep that in mind. When you're doing your closing cost allocations from a seller, make sure you're allocating every penny to what it can be spent on. Okay. Last but not least on here, common misconceptions. One of the big ones is that you can only use your VA loan once. No way. You can use it as many times as you want, as long as you still have your entitlement. So every veteran that has VA entitlements has an entitlement amount that they can spend. When they buy a property, that entitlement goes down. When they sell that property, the entitlement goes back up. Okay. If you max it out, any difference has to be paid with either a conventional loan, FHA loan, or cash. You sell the property, it reinflates that balloon. Okay. So that's one of the big common misconceptions is you can only use it once. Another common misconception is that you can only own one house under VA financing at a time. That's not entirely true. Now, the VA doesn't want you to live on 123 Banana Street and then, decide, yeah, you know what? I like the house behind me on Apple Valley better. So I'm going to rent this house out and go buy the house behind me using my VA loan. No, they don't like that. But if you live on Banana Street and you get deployed and rent out your house and then you move back to San Antonio and you buy the house on Apple Valley, guess what? No harm, no foul. You left the market, you came back, we're good. If you PCS, you move and you go to a different state and you buy another VA home, we're good. You can have more than one VA home, okay? Anything else anybody has questions on VA or wants to add about VA? That's like the super hyper Cliff Notes version, you guys. So if y'all do have questions, reach out to me. I'm a VA all day. So USDA financing, I'm going to go through this one really quick. Think of the military, okay, the VA financing for people that want to live in the country, okay? If you want to get out of the city, go live out of the city. 0% financing options. You do have income limitations. So the trick here is you actually have to be below their income threshold. Sounds crazy, right? There's like a window that you have to be in, but you actually can't exceed their limitations. And you have to meet their credit score requirements, which is similar to a VA buyer, which is about 580. Okay. You do have mortgage insurance on the USDA loan. So they're kind of combining, hey, look, we've got conventional over here and we've got VA here. They got together, had a baby, and popped out USDA. Okay. It's an encouragement to get people to live outside of the city into the rural markets, open up farmland, open up acreage, open up some type of entity outside of the city to live comfortably. Okay. I think it's a pollution thing. They're like, let's get people out of the city, reduce the smog, and we're good to go. Give them value and benefit. So USDA opened up. All right. So which loan type is right for your client? The answer is, who knows, right? Depending on the client's financial situation, depending on the client's job, depending on the client's wants and needs, they may look at a different loan type than what you would consider. Okay. My recommendation, get a really good background of the client. Figure out who they are. What do they do? What's their hobbies? What's their interest? What are they doing in work for work? What kind of lifestyle do they have? and then identify what loan types are going to be a good options for them. I'll go to my lender and say, hey, look, this client's veteran. He's stuck on a VA loan. I love the VA loan, but sometimes it doesn't have the best interest rate. So I'm going to tell my lender, hey, look, let's run him on a VA, but I want you to also consider him on conventional. Okay, he's got some money for a down payment, so that's not the issue. The issue is VAs want to go VA 9 times out of 10. But let's check out the conventional side. See if the rate's better. See if the fees are better. Okay, sometimes you can get it better on the other side than you can on one side. So take a look at that and figure out which loan type's actually going to be better for the client. Kay, I'm not entirely sure if you guys are sent a link every single week. I know I do as the instructor, because they're like, Jonathan, don't forget, you've got a class coming up. And sometimes I'll still forget. But I don't know exactly if y'all are notified every single week. I'll have to check on that. All right, so special loan types. Think about these outside of your normal, right? Conventional, FHA, VA, USDA. First-time home buyers, vacant properties. That one's kind of an interesting one. It's not everywhere. I've seen a handful of markets have this. But basically, if there's vacant lots or vacant areas around town that aren't, owned by somebody, or they're not being utilized how they should be, the city's like, we want this lot done, right? We want a house put on it. We want the yard to be mowed. Let's sell it. They'll actually do some nice credits for you on vacant land inside the city. Condo properties, educator, first responders, these are newer. I first started seeing educator and first responder loan types around 2020 when COVID was really taking peak. They were like, hey, these people need some type of better entitlements or better, services. Let's give them a special loan type. So they started popping those out. Excuse me. And then, of course, location specific, right? If there's an area around town that they're really trying to develop or up and come, they're going to give some special loan types to encourage people to move into that area.
So
Next up, go ahead, Tariq.
first-time home buyer program, I think you mentioned that going to be localized. Is there any federal program as well?
I'm not familiar with a federal program. I know a lot of it's local because a lot of it is like grants from either cities or organizations in the city that you're servicing. Really what it is it's basically a grant. It puts stipulations on the buyer for how long they have to live in the property, what the fees are if they sell it prior to that time frame, those types of things. So it's going to be organizations that are typically local to your market.
So how to find okay, so I have to work with the lender to find out, right?
Go to a lender, or, for me, I would just type in first-time home buyer loan options, San Antonio, Texas, and it'll give me organizations that have like grants or programs for first-time home buyers. All right, so real quick, the underwriting process. Basically, if you remember at the beginning of the call, we talked about the pre-approval process. Now we're going to do the same thing with the underwriting process. The main differences here are, one, you've got the purchase contract. Okay, so they're going to review that and make sure that it makes sense. And number two is you're going to have the appraisal on the property. Okay, so they want to get the appraisal. They want to know that the home's value is fair and that the bank is protected and you're not overpaying for the property. And then they're going to approve the loan. Okay, the biggest thing I want you to be cautious of here is there's some lenders that are like, hey, did you get a home inspection? Can you send that over? Nope, I cannot. Do not send your home inspection reports to your lender. Okay, they don't need it. If the appraiser sees something that they want to have repaired, they can call it out. A home inspection is not a requirement. A home inspection is not an underwriting requirement. A home inspection should be confidential to the consumer. Okay, you don't even have to share the entire report with the listing agent. As a listing agent, I don't want to see the full inspection report. Okay, because what happens when we know that there's something wrong with the property?
You have to disclose it.
Absolutely. Do I want to let people know that there's 3 outlets in the house that don't work? Heck no. I don't even want to know that, right? I know it sounds shady. Don't come at me. But my job as a listing agent is to represent the seller. If the buyer knows that there's problems with the home, has it been disclosed? Yes. Not by me, by an inspector who's more qualified than I am, right? They know about it. If they're not asking for it to be fixed, I don't care. That's their prerogative. Right? It has now been disclosed. But if that buyer gives me the full listing report and they decide to back out of the deal, I now have to let everybody know what's wrong with the house. And that's bad juju, right? So don't send me the full report either. But you do not have to send it to the lender. Okay. Do's and don'ts. Encourage your client to speak with the lender as early as possible. Okay. During that very first phone call, if you guys saw episode 1, we have about a 10 to 15 minute phone call with the consumer before we actually meet in person. During that first phone call, I dropped the hint. Hey, don't forget, we're going to need to talk with the lender. If you have somebody in mind, great. If not, we'll talk options when we meet in person. They're knowing from the very start they have to talk with the lender. Okay. Do obtain a copy of the pre-approval directly from the loan officer. Again, trust but verify. I trust my client wholeheartedly, unless it's about finances. Then I'm going to go directly to the lender. Okay. Do not guarantee financing terms on your marketing. Buy this property, $1,000 down, 3% interest rate. It's only going to open you up for, a lawsuit. Okay. Hey, great financing terms. It's a little loose-lipped. It's not specific. What's great financing terms? I consider 7.5% great. It's better than 12, right? Not saying to do it. Use caution, but optional. Okay. Do not discriminate against specific loan types. This primarily goes to my VA people. Everybody likes to discriminate against VA loans. Don't do it. There's no reason to. Learn the process, understand how the loans work, the different types of loans, not just VA, how the different types of loans work. So that way you can navigate those waters for your client. Okay. And last but not least, any questions, comments, or concerns? Okie doke. Well, you guys, for those of you that do have questions, but maybe don't want to ask in front of everybody, which is totally fine, that's my cell phone number down here at the bottom of the screen, 980-9556. Feel free to save that. You guys can text me. You guys can call me. You can message me on Workplace, but it doesn't notify me like I want it to, and I don't know how to get it to fix because all my notifications are on, but it still doesn't. So if it takes me a minute to get back to you, I apologize, but I will get back to you. Otherwise, that is my cell. I'm happy to connect with you guys online and off. And Hazim, I will try to get an answer for you regarding financing options and things like that up in Canada.
How can you get this slide? Is it available online?
So it'll be posted on Workplace. As far as the slides go, the slides are not available just like for download, I don't believe. If you go into the Real Academy, you may be able to get the slides, but I don't know if they have just the slides on there. If you message me, send me a text or a message on Workplace. If you message me, I can get you a link over to my Canva presentation and you can kind of see it from there. And Cody, I'll see what I can do. Shoot me a message, please, because all of this deletes, so I want to make sure I remember. But shoot me a message. That way, when I'm done with my coaching calls today, I can go ahead and get everybody taken care of. Perfect. If there's no other questions, I am done. Schedule for the rest of the classes here on the screen. We're going to be going over, listing presentations, running the business, being the CEO, increasing your marketing activities, things like that over the next couple of weeks. So hope to see you guys back on the calls. We'll be here again next week. Thank you.
Thank you.